Welcome to the FarrCast, kicking off our 7th season of giving you insight into Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. I was off for 3 weeks over in Spain, and great friends filled in. Harry took control. Jim Lebenthal sat in the chair, and things went just fine without me. Absolutely fine without me. I'm happy to say. It worries me a little bit, but I think we'll be okay. I'm back, folks, and this is season 7. This is the first episode of season 7 of the FarrCast. Tony Kornheiser was the one who made me start the FarrCast. He's been having his podcast for years, and Tony and I play golf together a bunch, and he said, Michael, you've got to do this. You've got to do it. So I did it, Tony. So I did it. And I have a lot of fun making fun of Tony over the years, and he throws it all right back to me. So what are we looking at? We're looking at a year that has beaten most folks' expectations for stocks, and I think has surprised some a bit on bonds. Month of September should not have surprised anyone, particularly if you've been listening to Polcari and Farr. September goes down. The market had gone up. It had been a great year, and September's always rough. And there are a lot of reasons heaping on to why we might be having a rough September. The government isn't helping at all. The Federal Reserve isn't helping all that much, though I think they've done a pretty good job all in all. A lot of mistakes, but we're still trying to sort our way through the direction of stocks. Is the economy expanding? People who get polled say they don't like the economy. The economic data are still pretty good. That's why the Fed's pretty worried. But the consumer's not feeling it, and the consumer continues to run out of wallet. So some of the high-flying stocks are pulling back. Some of the low-flying stocks are pulling back. What's it mean for your portfolio? What do we do for year-end? And what are we going to make of Washington? We've got a great show for you here, season 7, episode 1. And we're starting with Kenny Polcari, KP, the voice of Fox Business Television, the voice and face. Welcome back, Kenny.
Listen, first of all, I can't believe that it's 7 years.
7 years.
You've been doing this, and you and I have been doing this. I mean, listen, I've known you for more than that, but I can't believe it's 7 years that we've actually been doing this podcast together, because I've enjoyed every minute of it, I should just tell you. And I've also enjoyed watching you get a little bit older and older and older. Just saying.
It's a race to try and catch up with you, and so far I can't do it. I'm still trailing in the age
by about 2 weeks.
Am I younger or are you younger? I'm younger, correct?
That's by 2 weeks. You're younger by 2 weeks.
All anybody needs to know is Farr is younger than Polcari. Farr is younger than Insana. Farr is younger than Jack Barugian. All within a month. We're all within 30 days. It's amazing. Okay, Kenny, markets are going down. Everybody's running around like the hair's on fire, except you and I are going, why? This is what it does.
And we talked about this, going into September, that people should expect it, that it's not anything that's going to be out of the ordinary. Now, I will tell you that I think, kind of the mid part of the month, it was like a head fake there where was the market going to do the traditional September thing, or was it going to suddenly turn around and move higher? And I think that was a head fake for a lot of people. But in fact, you and I continued to say, slow down, not so fast. And look what we've seen over the last week and a half or whatever it is. The market has really come under some pressure. To our point, it's part of it's seasonal, part of it's the government, part of it's more shutdown talk, part of it's the UAW and rising prices, part of it's the uptick in CPI that suddenly they want to say they have under control, being data dependent and everything. The data starts to point up and they go, oh no, we're good, we're going to pause, which I think was a mistake, and I think that's going to become clear, and I think that's what's adding to this end of the month.
Okay, wait a minute. You think the pause was a mistake, KP?
Absolutely, I thought it was a mistake.
Why?
Because they keep saying they were data dependent. And before the meeting, the data started to suggest that CPI and PPI was ticking up again. That while the trend was still down, it starts to tick up. So therefore, I thought that was the message that that the economic data was saying to the Fed. Not yet. This was very reminiscent, Michael, and you and I both know this, exactly what they did in 79 and 80 when they paused. They thought they had under control, and suddenly it wasn't. And then they had to go back and redefine the narrative, and then they had to jam rates higher, and then they sent the country into a 2-year recession. Now, I'm not suggesting that's what it's going to be this time, but I think the mistake they made was I think they should have raised in September and then looked at the data, because the August PPI and CPI was higher. The August PCE was higher. The September CPI and PPI were higher. And so, to me, that said, we should raise one more time and just keep our foot on it until it starts. So, and now I think, once again, I think they've missed it, because I think the PCE tomorrow is going to be elevated. The question is it going to be more than what we already expect it to be? I don't see how it can be less, unless they concentrate on the super core, which is when they take everything out and they go, oh, look, there's no inflation.
Okay.
Well, of course not. You've taken everything out.
All right. Well, we're getting pretty well into the weeds, and it's getting a little bit wonky, but I'm going to disagree with you.
Okay.
I'm going to disagree and say that I think they probably should have paused. And I think they should have paused because they raised over 500 basis points in 7 or 8 months. There's a huge lag effect when the Fed does these interventions and interactions, and it takes a while. And it takes a while for you to see the changes in the data. How hard have they stepped on the brakes? Yes, you had seen the data pick up a little bit here in the short term, but you're looking at a long-term trend. You're looking at the short-term reaction, which can be very volatile in the short term, and longer-term trend. CPI was coming down and PPI was coming down, and the PCE on the overall trend is coming down. You've got positive rates now, right? Real positive rates. So I say, give it a break. You can always do a little bit more later, but you've done a lot. And I say, I'm with them. I'd give them. Let's sit. It could tick back up. But I think it's better that they move a little more delicately, a little more surgically. If they were my surgeon, I'd want them to move a little more delicately and quit cutting and see if perhaps it's enough at this point.
Okay, so listen, I hear you. So I can say 2 things about that. Number one, you're a little bit younger than me, so I got a little bit more experience.
I am a lot younger. Yeah.
But the second part is, while I agree, I think they should have raised in September and then look to pause in November. That's where I would have done the pause. I would have just reversed it. Now what they're going to do is they paused in September, and now they're going to have to, in my mind, they're going to have to raise in November, especially if PCE, CPI, and PPI come out even hotter than expected. I think then the conversation turns to, is it 25 or is it 50 basis points that they're going to hike?
Okay. So we will disagree here, Kenny. You and I don't do it. You and I don't do that. We don't disagree all that often. So I hope it's a little bit interesting for our listeners that we're disagreeing. I think that this pause makes sense, and we'll see here. The other thing that's been there's always parts that are different every time as you go through this. The whole thing rhymes. The whole thing. You went back to 79, 80. I was going to go to 87. You remember August of 87, and the bond market started to fall apart, and the stock market said the bond market was wrong. Let me tell you something, folks. Bond market's never wrong. Stock market will catch up with the bond market every time. So,
because remind everyone, in case you got listeners who weren't there in 1987, what happened in October?
Yeah, we had a 20% drop in one day, 519 points. And it was bedlam because we didn't have computers and we didn't have internet. And you would send your ticket to the floor of the exchange across a wire, and you might not get an answer back for days. You couldn't get a confirm. You didn't know if you'd had an execution on your order at any price. It could have been for hours or it could have been for days. Can you imagine trying to sell General Electric today, ladies and gentlemen, put in an order to sell GE, or put in an order to sell Microsoft, and you have to wait? You would have to wait. It was always like 15, 20 minutes before you would get word back from the stock exchange that your order had been filled. And then you pick up the phone and you call your customer and say, "Hi, Mrs. Jones, we sold the IBM and here's the price." Now you do it instantaneously, but that's not the way it worked. And when those orders and volumes of 1 billion shares We had a 500 million shares in a day. That never had happened before on the New York Stock Exchange. Kenny Polcari was down there. At that point, Kenny's hair was still dark, folks.
Yes, remind your listeners that I was actually on the receiving end of those orders, that when the trading desks were calling them down and screaming, sell it, sell it, sell it. They didn't care. They weren't even considering. They just get out there and sell it, okay? If that's what you really want to do. But it was bedlam, absolute bedlam. And you and I should have a whole series. We should have a whole Zoom about that, because I love telling that story, especially to people who weren't here so they understand it.
I watched some stocks that day and bought them.
Yeah.
I watched some stocks that day and bought them, and I didn't have any money. And I was 20. What were we? 26, Kenny?
26. 26.
Yeah. And I had very little money, but you know what I bought? I bought Circuit City.
Did you really?
Yeah, I bought Circuit City because they took it out and they just crashed it. I mean, they took it down to it was so ridiculous what happened in hours. And at those moments, folks, you look up and you say, all right, this stock, and you've seen this happen before, this stock was worth $50 a share this morning. It had a $1 billion market cap. It's now $20 a share. Wait a minute. It's $20 a share. Right. It's now got a $400 million market cap. It was $1 billion this morning. This happened. I'm not making it up.
Well, listen.
Happened in one day. And you look at it and go, now, maybe it was a little too high at $1 billion, but 400 million in 6 hours, that's supposed to make sense to somebody? That's when you buy. That's when Warren Buffett says, be greedy when others are fearful, Kenny Polcari.
Listen, the one that sticks out in my mind on that day when you talk about how ridiculous and how crazy it was Johnson & Johnson. Now, Johnson & Johnson, a major international mega cap company. It had closed at $96 on Friday the 16th. Do you know where it closed on Monday night? It closed at $45. It lost 50%. It's Johnson & Johnson.
50%.
It lost 50% of its value in 6.5 hours. It was crazy what they did.
Yeah, but you know what happened? You know, you say Johnson & Johnson's down 50%. If you said that they're having everything off at 50% over at Target, you couldn't get in the place.
Exactly.
When you said Johnson & Johnson is down 50%, they said, sell it, sell.
Exactly. Well, that's what the crazy part was. And they were calling me up going, sell the goddamn stock. I'm like, whoa. Listen to yourself. But look, I was the broker. I get paid to do what you told me to do. If you told me to sell it, I sold it.
Well, it was, I hate to say, but I was a brand new stockbroker at that time. And everybody would come up to me and say, oh, God, this must be the worst time in the world of starting this business. It's just horrible. I said, no, it's great. They said, what do you mean it's great? And I said, everybody hates their stockbroker. Everybody hates them. I didn't hurt anybody. I didn't have any clients who could lose money in this. Everybody I talked to was willing. And half the stockbrokers were scared to call their clients because they figured they were so pissed off at them. Okay, Kenny, we're spending too much time in the past here. Between now and year end, what happens to earnings? What happens to stocks? We got to go. Believe it or not, we're out of time.
So here's what I think. I think we stabilize right in here. I think we end the year at 4,500. I think the market does kind of adjust and stabilize going into year end. I don't think it's going to be rocket ship, but I think we go right back to where we were before the sell-off happened.
460 on the 10, 463 on the 10-year this morning. This thing's dropping like a big rocket. Hit 465, you know. Yeah, 465 just a couple hours ago. So where does that go when this political shutdown happens? That's going to happen Sunday. We'll ask Mahaffee about it, but that's what I'm going to bet on. We'll see what he says. I mean, as this nonsense happens, could there be more of a shakeup? Could you see a 20%?
Oh yeah, I think there could. And I think the number that people have to watch is you have to keep your eyes on the long-term S&P, the trend line, which is at 4,200 basically. We're only 80 points away from there. We could test it and kiss it. You want to see the buyers defend that position. If you don't see the buyers defend that position, it's going to set off a technical response in the algorithms. They're going to send wave after wave of sell orders because we've broken a key technical level, and that'll push the market down. I think it is going to defend the position. I think the buyers out there are going to defend it. So I'm not looking for that. I'm not looking for that disaster to happen.
4275 is where we are on the S&P 500 right now. You say 4500.
42, yeah, 4,200 on the way down, right? It's going to test that. And then
Yeah.
I think it ends the year at 4,500. That's right. Somewhere between 4,450 and 4,500 is where I think it ends the year.
So you think we've got another 6-7% to the upside?
Yeah, I think we could do that in the last, but between the end of October through the end of December, I think we could rally that back. Yes.
Okay.
Now look, if the government shuts down and the Fed starts talking crazy about raising rates 50% and the 10-year Treasury goes to 5%, then I guess you and I should have another discussion.
Yeah.
Right.
Well, that's going to be, if you ask me today, how do you spell ugly?
Yeah.
That would be it. And let me tell you, on the Scrabble board, I've got all of those letters lined up in my little tile tray. Okay, all of them are lined up on the tile tray. I can get there. I can put those letters together and make it spell ugly just that way.
Yeah. Do you not? Where do you think the year ends up?
I've been so wrong all year. This year, I don't know how stocks have done what they've done. I think that you have a significant amount of air still to come out of the Magnificent Seven. I don't think they hold up at these levels through year end. So I see an adjustment there. I think we could be flat from here by the end of the year. I don't think that'd be horrible at all. I think you could see 4,000. I do. I think you could see a bit of a pullback here.
200 points. Down 200 on the S&P.
Yeah. Yep. I think so. I don't
Harry, book another session because we need to talk again.
Well, we're just getting started with season 7, baby.
I hear you. Bring the therapist on though the next time.
at his age, Harry, book him. Don't book him too far in advance. He's not buying green bananas.
Time is not on my side. Is that what you're saying?
Kenny Polcari is the chief market strategist for Slate Stone. And he is the voice of Fox Business, the voice of the New York Stock Exchange, our great friend. Thank you very much, Kenny.
Thank you, Michael. Talk to you later. Hello, Mr. Mahaffee.
There's Mahaffee, who are coming right back with Mahaffee, the Dan Mahaffee, right up next on the FarrCast. Please stay with us, season 7.
Thank you for joining us this week on the FarrCast. Now it's time for political analyst Dan Mahaffee and your host, Michael Farr.
Welcome back to the FarrCast. I am Michael Farr. Season 7 of the FarrCast. Thank you so much to our loyal listeners around the country and around the world who have been loyal to us and sending us notes. Season 7 of the FarrCast. Unbelievable. And here, for each and every of all 7 seasons, our senior political analyst, Dan Mahaffee, from the Center for the Study of the Presidency and Congress, our senior political analyst on the FarrCast. Welcome back as we begin season 7, you old man, you.
Good morning, Michael. Season 7, lucky 7. Here we go. After all the ones we've had, I don't know how the world is going to try and top the past 6 seasons, but buckle up.
Well, buckle up, because so far we've got a lot of grist for this particular mill. Washington still doesn't ever disappoint, and we've got a government shutdown because they can't agree on a budget. They can't agree on spending. The government runs out of money again on Sunday. And Dan, what's happening? Are we going to shut down the government?
We are going to shut down the government, barring truly something miraculous. So now it's really a discussion of what flavor of shutdown does this have? Is it a weekend type one? Because look, the Senate does have a package. They could amend it here and there to maybe add some stuff on border to satisfy some folks in the House. And if you had this really in its shortest form, you would look for something like a deal where, like you almost did have during the debt ceiling, where something comes from the Senate, some Democrats support McCarthy in the House, you get a bipartisan vote in both chambers, and maybe government reopens early next week. That I don't think is as likely, though, because McCarthy has this band of conservatives that are even more dug in. And in many ways, those far-right conservatives are going to be getting messages from their constituents saying, you're doing the right thing, dig in, shut that government down.
And okay, but and to what purpose here? If we get something done this weekend, it's a continuing resolution so that we go through this again in what, 6 weeks?
That we do go through this again in 6 weeks, but perhaps that gives time for McCarthy to at least show what he can pass through his chamber.
What
But
makes you think you're going to find out in 6 weeks what you haven't found out in the last 6 months? McCarthy can't get past these 5 guys. He barely got through them after 16 friggin' votes to get to be speaker. And how does he keep his speakership? Is there a real way for him to get the Democrats to keep him as speaker, knowing that the Republicans won't ever get another Democrat in as speaker? Can they work enough?
No, Democrats will never save him as speaker. They will help to pass legislation through, but they will never save him as speaker because that's the Democrats will say is the Republicans' problem. What McCarthy will also say to you on the 6 weeks, and his rejoinder to you would be, well, I'll take as many votes as it takes during these 6 weeks to get something, just as I took as many votes as it took to become speaker. And anyway, if you want to replace me with someone, who?
Well, they don't have to have that answer. They can vote him out as speaker without voting someone else in.
Again, but that pushes once they do that motion to vacate, it is who will vote for it. So will the Republicans save him? How do they push this? How do they delay it? These are all unknowns that come, though, after you get something through. He still has to get something to be pushed out, and then either he exists in this state of nothingness.
Is it your call that something gets through here by the end of November?
I would say that there is something by the end of November, simply because the pressures
CR?
on Ukraine. It probably is a CR, and that's why the 2023 numbers were written in such a way to anticipate this. But again, there will still be those penalties that may kick in under the budget deal that they pass on the debt ceiling. So what you have then is sort of the worst of all worlds when it comes to budgeting, because no one's accomplished anything. No one's been able to adjust their priorities or reorient anything. So no one wins in that scenario.
So what happens now, Dan, in Congress? Does everything just happen to stall here if this doesn't get done?
Yes, it does stall. And you see things like defense, agriculture, the FAA, all these little things that need to be maneuvered and run, the trains that keep on time. The circus train has derailed and everything else is stuck behind it.
You know, Dan, as Kenny Polcari was reminding me, I have gotten older over these 7 years, and I am 62 years old now. And you start to reflect and think a little bit more about things. And one of the things I was thinking about the other day is, what are the sort of triggers that make me angry? What makes me angry? And there's not a lot, really. I mean, certain injustices and harm, and there are some things that really make me angry. But personally, I find I get angry when I really feel unable to affect a change, when I feel unable and impotent to make a difference. And I look at what's going on in our Congress, and I look at what they're doing, and I think, all I do is get angry. Please do something. Please do your jobs. Stop this. There's a country here, and it's a wonderful country, and you're not doing your damn jobs. I don't know what it is that you are trying to accomplish, but it's really clear to me it's not the good of our country. It's not the future of America that you're really trying to benefit with all of this nonsense and self-serving stuff. And it really does make me angry. And that we can't seem to elect the people who will do it the right way makes me angry. And speaking of which,
Michael, I feel that's an issue too, where you have 40 to 60 truly obnoxious loudmouths overshadowing a decent number of people who do want to get work done.
Yes, you're right. Yes, you're right. You can't throw the baby out. And there is a baby there in that bathwater, but boy, it's some dirty bathwater right about now.
Right now, yeah.
Dan, speaking of dirty bathwater, the Republican debate last night, if you want to call it a debate, there was a lot of dirt being slung around there. And I read all the reports this morning from all of the wonks who say, well, Nikki Haley won. And I think, really, what did she win?
Nikki Haley won perhaps the undercard title and her time in the spotlight for the Republican donor base, but it's not going to move the needle unless the voters feel that there's a real alternative to Trump, or more fundamentally even want an alternative to Trump. And
Do
right now,
they want an alternative to Trump, or is Donald Trump just going to get he's going to get the nomination? Is whatever. I mean, that's common. The common opinion now is Trump absolutely has the nomination, and the others are wasting their time. Are they just fighting for the VP slot?
fighting for perhaps their role in the future of the party. I don't think any of them, if they're going to distinguish themselves as the VP spot. Look, the Vivek Ramaswamy, there's a lot of people who on social media who like his message, as sort of nonsensical as it is to the conventional political world. All of these things, I think, are positioning themselves around the future of the party and to be there perhaps if there is a sudden public turn in opinion because of a legal case or something that you see here. Thus far, though, that is not what we see trending. The Republican voters are still around the base around Trump, despite the fact that most in the party establishment and the party donor base would much rather have someone else.
So the wisdom has been, or the consensus has been, that if it's a Trump-Biden, 6 months ago, they said Biden win and Trump is unelectable. He doesn't look unelectable to me.
No, I don't think you can discount Donald Trump in any way. And there are some polls that show Trump could pull ahead in some shocking way right now. I also think, though, that the polling right now, you have to caveat it with the fact that it's a lot more of an abstract matchup than something very real down the road. But again, Biden's health remains a wild card. The lack of clear alternatives or choices, though, on either side, as much as they tried to make themselves out to be alternatives last night, means that the trends point to, again, that rematch. And again, wide dissatisfaction among Americans about having those two choices. And frankly, a 2024 rematch answers none of the wider questions about our politics. It just sets up a repeat of the same grievances for another 4 years.
Here's a very unfair question for you because, you know, a month is a long time in politics, and I'm going at it over a year here. Are we going to see Biden, Trump on the ticket? Is that going to be the 2024 slate?
Michael, as I was saying to Jim while you were away, we're 2 political lifetimes away from that slate. What I can say now is there is no evidence to the contrary that it won't be.
And if there's no evidence to the contrary that it won't be Trump, Biden, who wins?
I think Biden does, barring a significant health collapse or issue with his age late in the campaign. The legal mess, the memories people have of the unpredictability, the way he is seen by women and young people. I don't think you see Donald Trump prevailing in the swing areas that decide our presidential elections.
Donald Trump is pulling way ahead with minority votes, both with African Americans and Hispanics. That's almost never happened before. It seems that the Democrats are losing their hold on those parties.
Look, I think where the Democrats are having the biggest trouble there is because those are the folks that are also hit hardest by inflation. And they're the ones, too, that actually bear the brunt of the soft on crime policies that people from the suburbs advocate for.
You know, I look at Washington, Dan, and I'm thinking we've got a huge problem, $33 trillion in debt, and we're adding to that debt at over $1 trillion a year. And these folks are arguing, and there don't seem to be solutions out there of this economic problem that we have. And we have an underlying economic cancer, folks, where debt is building and building and building at a much faster rate than the nation's income, than the GDP growth. Isn't growing anywhere near as fast as the debt. And so the debt and the service, imagine if your credit card were growing a lot faster, credit card balance were growing a lot faster than your income, you've got a problem because that compounding at 20% or 22% on those credit card balances takes on a life of its own. And as I look at it, folks, something has to be done. And also, we have an energy cost issue in this country, and there are solutions to that energy cost issue. And they're not all drill, though we have oil that we can drill in this country, and we need to be more oil self-sufficient. We also have nuclear that everybody's fighting. We have lots of different types of energy that will not have the same impact on the environment, and we need to go after it, and we need to produce it. We need workers as well. We need immigration. How about limiting immigration to people who have college degrees or graduate degrees? I don't care, but we need it. And then finally, we really have to focus on our AI. We have to focus on the productivity that can come from this new marvelous tool, and hope that it doesn't take over the world, and put all of the right stopgaps and rules and borders in place. And that's a bold agenda, but that gets our economic footing back under us, builds that foundation back, and then America can prosper again. Right now, the only thing we're proving is that America can spend itself into a very deep hole. And when confronted with more problems of this inefficient economic model, they just keep digging the hole deeper. Tell me what I've got wrong, Dan.
Michael, I think you've got a lot of these right, and you've hit where basically all of these are things that have been talked about, but politicians aren't willing to tell the voters to eat their vegetables. Instead, you get a big heaping plate of culture war, and therefore you're distracted by policing in the cities, although crime is real, but you have these movements there. You're distracted by what you see in schools and the library campaigns and book banning. You see it, and again, I say it again and again when I'm overseas and I'm asked, hey, Americans, you're arguing about who's using what bathroom when the Chinese are orbiting the back of the moon. What are your priorities? And what are your politicians saying? And we have these cycles where, again, Michael, this is not being talked about because our politicians, the media, and really the voter bases who come out in the primaries are all incentivizing our politics to be more like professional wrestling than really solving problems and governing the country. And that's why you end up where we are with not only the shutdown that we have in the actual functioning of government, but the inability of government to deal with any of those big topics like you described.
Politicians who stick their fingers into the air to determine which way the wind is blowing are finding a lot of Americans, a huge number of Americans who say, we don't want to hear about vegetables, we want to go to McDonald's, and to which the politicians respond, well, then we'll supersize it for you. We'll supersize it for you. Doesn't matter if it's going to kill you. If that's what you want, we're going to give it to you. Great. And then make sure you vote for me. It's not the way to do things in this country, folks. We are in desperate need of real leadership. And to Dan's point, there are some real leaders in our Congress right now, and it sure would be nice to hear from them and shut these other people the hell up. Thank you so much, Dan Mahaffee, Director of Policy for the Center of the Study of the Presidency and Congress, our senior political analyst, Season 7 of the FarrCast. When we come back, Dr. J. Bryson, Chief Economist at Wells Fargo, going to explain what he thinks is going on with the Fed, and we're going to ask him if he agrees with Polcari that they should have hiked one more time. Please stay with us.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. We appreciate you listening into the FarrCast this week. And now to introduce this week's special guest, here's your host, Michael Farr.
Welcome back. I'm Michael Farr, and this is Season 7 of the FarrCast. And joining us now, once again, and I think you've done this for 7 years too, Jay. I think I think you've probably been with us all 7 years.
They all start to run together after a while, Michael, but it's been a while, that's for sure.
It's been a while, and boy, has it been great for us and for our listeners, Jay. We always learn so much. Dr. Jay Bryson, chief economist at Wells Fargo. He was on the Federal Reserve, professor of economics. I mean, one of the smartest guys we get to talk to. And the thing I love talking to you about, Jay, is that you're always so clear. You make things understandable that are really complex and intimidating for me anyway. And you've got to make it simple for me, folks. I promise you got to make it simple for Farr. So we were talking, Jay, with Kenny Polcari, and he said he thinks the Fed made a mistake in pausing and that they should have raised at this last meeting, and that if they're going to be data dependent, the data, in fact, were starting to tick up and they should have increased. And I argued with him and I said, no, Kenny, I don't agree with you. I think short-term data can be very volatile, but the long-term trend for the inflation numbers is still coming lower, given a 500 plus basis point increase in rates. I think a pause to see what the real lag effect is with real rates actually on the rise made a lot of sense. What do you think?
Michael, I tend to agree with you as well. I mean, we are starting to slow down in the economy. Data that printed just recently showed that GDP in the second quarter grew 2% at an annualized rate, or 2.1%. I mean, that's, relatively slowly. You mentioned the 525 basis points that the Fed has done. That comes in with a lag that nobody really knows, how long it is. So I think a pause at this point, as inflation is receding, is probably the right way to go. I mean, if the data over the next few weeks continue to come in strong, or are strong over the next few weeks, the Fed can always go on November the 1st. But at this point, you probably want to be slowing down the pace of rate hikes.
And if they come in November the 1st and they say, okay, we're going to raise another quarter, that quarter of a point in and of itself isn't going to be all that material to the gross U.S. economy. Is it enough of a sign, which is what they're trying to do, right? I mean, this is sort of how many angels can dance on the head of a pin. I mean, what rate becomes material? What's the point in raising a quarter of a point even on November?
Well, it does show that, it does help their credibility. It would help to keep the long end of the yield curve, from going out even further at this point. So it certainly helps there. But what really matters for the real U.S. economy, for real growth at the end of the day, is not that nominal rate, which again right now is about 5.50. What really matters at the end of the day is what's called the real Fed funds rate. So that's that rate minus inflation. So think about it, right? If you have a real or a nominal Fed funds rate at 5.5%, and inflation is 10%, you're a business. Your borrowing costs are, let's call it 5.5%. You can raise prices by 10%. Why wouldn't you take out a loan in that situation, right? But if the inflation rate is 0, well, you can't raise prices, and your interest costs are 5.5%. Now it becomes much more tight, right? And so that's what matters. And as we go forward, even if they keep rates on hold here, as inflation continues to come down, that real rate is going to go up. And so what you're going to get in coming months is a passive tightening of monetary policy. The Fed's not hiking rates, but as inflation comes down, the real rate drifts higher, and that puts more and more headwinds on the economy. And that's what you got to be looking at as we go forward.
Do we need the economy to contract here some? I mean, we've always heard the Fed really wants to see the economy grow, and 2% inflation is their target year in and year out. How slow? I mean, we've got this inflation that's been running hot, well above that 2% number. How slow does the economy have to get in order to resume something close to that 2% level? Do we have to go into recession?
No, we don't necessarily have to go into recession. And that's, all this hope about a so-called soft landing. But what you do need to do is the economy is probably operating above potential right now. And the reason I say that is if you look at the unemployment rate, this would be a good way to measure it. The unemployment rate's at 3.8% right now. Most people would say that if you want to call it the natural rate of unemployment, that's probably somewhere between 4 and 4.5%. And so what you need to do is you need to slow the economy enough to have that unemployment rate come back up to that natural rate. Now, that doesn't necessarily mean you have to have a contraction. But what you have to do is you have to grow below the potential growth rate of the economy. And what's that? Well, unfortunately, we don't know. It's unobservable. But most people would peg it right now, maybe between 1.5% and 2%. So the bottom line here is you need to grow less than that. You need to grow, let's call it 1% for a few quarters in order to bring that unemployment rate back up to bring your inflation rate down to 2%. And you know what? That's a really tricky thing to do if you're the Federal Reserve and all you have is the blunt instrument of the Fed funds rate, which operates with long and variable lags.
And taking that unemployment, this is brilliant, absolutely brilliant, Jay. So clear. Ladies and gentlemen, if that somehow went over your heads, go back, hit replay right now, go back 60 seconds or 90 seconds and listen to what he said again, and then listen to it again. One of the more important things you're going to hear anywhere in the media, he just explained it beautifully. Jay, if I look at that unemployment rate, I remember two things, and I interpret it this way. I want you to just tell me if I'm on base. One, I remember that you are the only economist I continue to read who says we've never had a recession without unemployment going up at least 0.5 point. And we need to see that if we're going to have that. It has gone up at least from 3.5 to 3.8. Do you still look for that, number one? And then number two, if we're looking for why, I'm thinking about why we need to see unemployment go a little bit higher. And my answer intuitively is it has to go higher so the pressure to give raises goes away. If there are more people who are unemployed, they will be willing to take whatever wage they can get. And then Walmart doesn't have to keep paying raises. And if Walmart doesn't have to keep paying raises, then they don't have to keep raising prices. And that wage inflation leads to other price inflation. And that's when things can kind of calm down and get us out of this inflationary spiral higher. Have I got it right, or what am I missing? Overly?
No, you've got it right. I mean, let's go back to that first thing. Yes, if you go back, and this is what's called the Psalm rule. If you go back and you look at, we have never, whenever the unemployment rate in this country has gone up by 0.5%, you end up with a recession. Okay, and so people will say to me sometimes, well, the unemployment rate's at 3.5%. How can you get a recession? And the answer is it doesn't, the level of the unemployment rate doesn't matter. It's the change. So if you think about it, if we have to go up by 0.5 percentage point or so, you're probably going to have a bunch of layoffs in that situation. And as people get laid off, they don't have as much money to spend somewhere else in the economy. And then that causes the whole economy to start to contract potentially. Now, just because in the past it's gone up by 0.5% and we've had a recession doesn't necessarily mean it has to happen this time, right? This time could be different. I mean, we'll see. But to get to your point about the to the wages, I mean, you had it exactly right. I mean, what you need to do is you need to generate some slack in the labor market for wages to moderate. Wages don't have to fall. They just had, and rather than have a year-over-year increase of 4.5%, we need to get that down to 3 to 3.5%. Because so when you think about the U.S. economy, we are what? A service economy, right? More than 60% of our spending is on services. What's the biggest cost component for most service providers? It's wages and salaries.
Yep.
Okay, and so that's why, in order to get the inflation rate down to 2%, you've got to get moderation in terms of prices in the service sector, and it boils down to moderation in terms of wages.
Yep. I mean, this all makes so much sense to me. Jay, I'm going to ask you a broader question now. So it sounds to me, before let me put a little bit of a bow on this. It sounds to me that you think that while they may have made certain errors here and there, in general, the Fed is where they should be right now.
Yeah, in general, right? So if you and I had this conversation a year ago, and I'm sure we did, I would have said, they were behind the curve. I mean, everyone acknowledges that, right? They waited too long to raise rates. Okay, but if you look at the last, since over the last year or so, by bringing rates up as rapidly as they did, they have increased the probability of a soft landing. What you don't want to do is keep rates on hold forever and then have to jack them up by 1,000 basis points. That's where you're going to get a recession. You could potentially bring the economy in for a soft landing here, doing what they did. I'm still a little bit skeptical that's going to happen, but I would be the first to acknowledge that the probability has gone up.
You have for years made me feel a little bit better, not a lot better. You've made me feel a little bit better about this, the amount of the U.S. debt, which still, I know, and this is probably because I'm unsophisticated, but it worries the hell out of me to see the debt increasing, and $33 trillion in debt, and having us continue to add to this debt the way that we are just seems entirely unsustainable to me. It goes against sort of every bit of just common old horse sense that I have. And I don't have much more than common old horse sense here, Jay. I'm limited as to what I can rely on. Is there a point where you get worried about it? Are you not worried about it? And why should I not be worried about $33 trillion in growing debt?
Okay, so first of all, what I would say to you is ignore the $33 trillion, right? Because I'll give you another number. It's not as big as that, but that's 26 trillion. That's the size of the US economy, right? So you've got to you have to scale the amount of debt out there by something. And we usually do that by GDP. Think of a business, right? I could say to you, Michael, I know a business has $1 billion of debt. Is that a lot? I think your first question to me would be, well, it depends on what the business is, right? I mean, if it's ExxonMobil, $1 billion is pocket change, right? If it's a mom and pop retailer down the street, $1 billion is probably excessive. So you've got to scale it with something. We do that with GDP, but even then, it's the highest it's been since the end of the Second World War. Okay, now, so do I worry about it? In the near term, no. Is this, are we looking at a Lehman Brothers moment for us here in the United States in the foreseeable future? No, because there's no alternative to U.S. Treasury securities. U.S. Treasury securities are the deepest, the market for U.S. Treasury securities is the deepest, most liquid, most transparent financial market in the world. There's nothing that comes close to U.S. Treasury securities. So, and you look at it right now, yes, yields are up in the United States, but it's because the Fed's been tightening. It's not like we're getting a massive, foreigners are dumping their US dollar debt. The dollar is really strong right now. Okay, so there's no indication yet of that. There's no indication that that's happening yet. However, if this continues, if we don't start to have, I'll call it an adult conversation in Washington about what sort of fiscal, how we're going to bring this about, because, Michael, at the end of the day, it's folks like you and me and people who are older than us. It's all about Medicare and Social Security. It's the entitlements, right? And we haven't talked.
I said that this morning on the Farr. As I started the FarrCast, I said, look, we've got to address entitlement. We've got to address a number of things, but these entitlements, we can't afford the money we're spending. We can't afford it.
Yeah. Right. So do I lay awake at night worrying about this today? No, but if under the current projections, the debt, more importantly, the debt to GDP ratio of the country is going to continue to go up. And what's going to also, another problem is, as if interest rates stay high, and they probably will, then the interest rate cost of the US government goes up, and then you start to squeeze out other sorts of things, right? Does it squeeze out defense spending? Does it squeeze out infrastructure sort of spending? Does it mean that you have to raise taxes? I mean, these are all, interesting policy sorts of questions. So it constrains what we as a public can do going forward if you continue to run up, debt the way we have.
Do you care about Reinhardt and Rogoff's report years ago that showed that when you get over 100% debt to GDP, that
no, I don't care about that. I mean, you can still have outliers. I mean, look, I'm not trying to disparage Ken Rogoff or Carmen Reinhardt, a brilliant economist.
Economists, yes.
Right. But okay, so look at Japan. I'll just give you one outlier. The debt to GDP ratio. So in our country, the debt to GDP ratio today is roughly 100%. Look at Japan, it's 250%. 10-year government bond yields in Japan are, last time I looked, 60 basis points.
Right.
It's nothing, right?
Right.
So, and Japan, we've been talking about Japan's debt problems for years. It hasn't come home to roost yet. Yeah. Will it eventually? Yeah. But I think that situation, if we were a developing country and we had to borrow in somebody else's currency, then I worry about it. But we borrow in our own currency. The US dollar is and will remain, for as far as I can see, the world's predominant reserve currency. Investors around the world want to hold US Treasury securities.
Ladies and gentlemen, I'm going to tell you that you just listened to a master class in economics explaining the US economic situation from Dr. J. Bryson that people would flock to at every economics department at every major university in this country. And most of the Federal Reserve economists would like to hear what he just said too. Jay, I can't thank you enough. What a great explanation. I want you to come back and I want to talk about China and why I think Xi Jinping is so misguided in trying to basically ignore his economy. No margin, no mission. That's an issue. Can we do that sometime?
Happy to talk about China. I have some opinions on China as well. So
excellent. I thought maybe you would. Dr. J. Bryson, chief economist at Wells Fargo, and from all of us at the FarrCast, we wish you many blessings and much congratulations. Coming up, ladies and gentlemen, Jay's daughter will be married this weekend, who's a great friend of our family's. And it's going to be beautiful and a wonderful celebration. And we're all going to be raising our glasses to you. Thank you so much, Jay.
Well, thanks, Michael. Appreciate it.
That's it for another FarrCast as we cover Wall Street, Washington, and the world here in season 7. 7 years of this, folks. Here we go. And we couldn't do it without you. Please share us on your social media. Tell your friends that you learned something today on the FarrCast. I know I did. We'll see you next week. For Harry Jennings, our producer, and everybody at Hightower Advisors, Farr Miller in Washington, thank you so much, and we'll see you next week.
That's a wrap for this episode of the FarrCast as we kick off Season 7. Thanks for being with us this week and every week. We hope you enjoy the show as much as we enjoy making it for you. Thanks to our guests, Kenny Polcari, Dan Mahaffee, and special guest, Dr. J. Bryson, Chief Economist from Wells Fargo. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly on all major podcast platforms, including Google, Spotify, TuneIn, and Apple Podcasts. Please share with friends and colleagues. Take care, stay safe, and stay healthy. And we'll be back with you next week on the FarrCast. Wall Street, Washington, and the world. Farr Miller in Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, an SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr Miller in Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr Miller in Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr Miller in Washington and Hightower Advisors, LLC and any of its affiliates assume no liability
or any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors LLC or any of its affiliates. Farr, Miller & Washington and Hightower Advisors LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.